In 2019, Sam Altman sat down for an interview and was asked a simple question: how does OpenAI plan to make money? His answer was one of the most remarkable things a CEO of a serious company has ever said publicly. And I want to read it to you exactly as he said it, because it tells you everything you need to know about what is happening right now. He said, the honest answer is we have no idea. We have never made any revenue. We have no current plans to make revenue. We have no idea how we may one day generate revenue. We have made a soft promise to investors that once we have built this sort of generally intelligent system, we will ask it to figure out a way to generate an investment return for you. We will ask the AI to figure out how to make money. That was 2019. Fast forward to 2026. OpenAI has not built artificial general intelligence. The AI has not figured out how to make money. What OpenAI has instead is $13 billion in annual revenue, $14 billion in projected losses this year alone, $74 billion in projected operating losses in 2028, $1.4 trillion in spending commitments against revenues that don't come close to covering them, a Musk lawsuit with a trial starting April 27th seeking up to $134 billion in damages, and a company that started running ads in ChatGPT in February 2026. The exact thing Altman had called their last resort, the plan to ask the AGI to figure out the business model, didn't work. And the actual business model they landed on, subscriptions, API access, and now ads, is losing money at a scale that would make any other company's board of directors resign in the middle of the night. And yet, OpenAI is currently valued at $800 billion, making it the most valuable private company in the history of the world, with a valuation that increased 181% in the 12 months between March 2025 and March 2026, while losing more money than almost any company has ever lost. This is the story that the financial media is not telling clearly enough. So let me tell it. Let's start with the actual numbers, because the numbers are the story. OpenAI's revenue in 2025 was approximately $13 billion. That sounds large until you compare it to the spending. The company burned through $8 billion in 2025 in operating losses. It lost $12 billion in a single quarter, the July to September period alone, according to actual accounting disclosures buried in Microsoft's financial filings, not leaked documents, not estimates. Real accounting from a publicly traded company that is required by law to disclose its financial commitments accurately, $12 billion in 3 months from one company. And the trajectory is not improving. OpenAI projects losses of $14 billion in 2026, rising to $40 billion in 2027 and $74 billion in 2028. Deutsche Bank looked at these projections and calculated that OpenAI will burn through $143 billion in negative cumulative free cash flow between 2024 and 2029, before turning a single dollar of profit. $143 billion before profitability from a company with $13 billion in current revenue. To understand what this means, you need to understand the plan, because OpenAI has one. It is aggressive, it is specific, and it is the kind of plan that requires essentially everything to go right simultaneously for it to work. The plan is this. OpenAI grows revenue from $13 billion today to $100 billion by 2028 and $200 billion by 2030. At $200 billion in revenue, the business generates enough cash flow to justify and service the $4 trillion in infrastructure spending commitments. The company reaches profitability in 2030. Everyone gets paid. Sam Altman is vindicated. The investment community exhales. That's the plan. Now let's talk about the math. Going from $13 billion in revenue to $100 billion in revenue in 2 years requires growing at roughly 175% per year for 2 consecutive years. For context, the fastest growing large companies in history. Amazon, Google, Netflix at their peaks grew at 40 to 80% per year during their best stretches. OpenAI's plan requires sustaining more than double the fastest growth rate ever achieved by any large technology company for 2 years in a row, while simultaneously managing $74 billion in annual operating losses. George Noble, a veteran financial analyst, put it directly. OpenAI needs to generate $200 billion in annual revenue by 2030 to justify their projections. That's 15x growth in 5 years, while costs keep exploding. And Senator Elizabeth Warren, in a detailed letter to OpenAI in January 2026, did the math even more bluntly. Even if you assume OpenAI hits $100 billion in revenue in 2028 and $200 billion every year thereafter through 2033, the most optimistic possible scenario, the cumulative revenue adds up to $1. $1 trillion, against spending commitments of $1.4 trillion. That's a $300 billion shortfall even in the best case scenario anyone can reasonably model. Now, the standard response to this analysis is that great technology companies always look financially irrational at the early stages. Amazon lost money for years before becoming the most important retailer on Earth. Netflix burned cash for a decade before becoming the dominant streaming platform. Patience is rewarded. The returns come. And this is true. Sometimes. But the Amazon comparison, which OpenAI's supporters use constantly, breaks down on one crucial dimension. Amazon was losing money because it was investing in logistics, warehouses, and infrastructure for a business model that already worked at small scale. People were already buying things on Amazon in 1998. The unit economics, revenue per customer, margin per order were already visible and improving. The losses were scaling losses, not structural losses. Amazon knew exactly how it made money. It just needed scale for the model to become profitable. OpenAI's losses are structurally different. The company does not yet have a clear path to the revenue it needs. The unit economics of running large language models are punishing and are not improving at the rate the business model requires. Each ChatGPT conversation costs money in compute. As usage grows, costs grow. The margin per user is negative and has been negative since the company launched consumer products. OpenAI is not losing money because it's building too fast for a proven model. It's losing money because the model isn't proven yet, and the competition is closing in from every direction. Google DeepMind has Gemini. Meta has Llama, which it gives away for free. Anthropic, the company founded by former OpenAI researchers who left over safety disagreements with Altman, is growing its enterprise customer base at a pace that is actually better matched to its cost structure. DeepSeek, the Chinese AI company, released a model in January 2025 that performed comparably to OpenAI's best models at a fraction of the compute cost and caused NVIDIA's stock to fall 17% in a single day when the market realized the implications. If a Chinese company can build an equivalent model for significantly less money, the entire assumption that massive compute spending equals competitive advantage starts to crack. And if the competitive advantage cracks, the revenue projections that justify the $800 billion valuation become increasingly difficult to defend. OpenAI's own researchers have been raising internal alarms about this. The company's next major model, internally called Orion, was trained on larger datasets with more compute than any previous model. And according to multiple reports from people familiar with the project, it did not deliver the expected jump in capability. The scaling laws, the principle that bigger models trained on more data produce proportionally better results, appear to be showing signs of strain. The curve that has justified the multi-trillion-dollar build-out is flattening. When Altman was challenged about this on a podcast, asked directly about the spending versus the revenue gap, His response was revealing. He became defensive. He pointed to investor confidence as evidence that the business model must be sound. An $800 billion valuation means the market believes in us, he suggested. That's circular logic. The valuation is not evidence of a business model. The valuation is evidence that investors currently believe there will be a business model. Those are not the same thing. And now there are new pressures that nobody was pricing in 6 months ago. The Iran war and the Strait of Hormuz closure has created a helium shortage. Qatar, which supplies roughly 1/3 of the world's helium, has seen its output disrupted. Helium is not optional in semiconductor manufacturing. It is used in the cooling and purification processes that chip fabrication depends on. A sustained helium shortage means higher chip costs and supply constraints for the data centers that OpenAI's entire operation runs on. The same geopolitical crisis that is raising your mortgage rate is now raising OpenAI's operating costs. And then there is the Musk lawsuit. The trial begins April 27th, 2026, in days from now. Elon Musk is seeking between $79 billion and $134 billion in damages, alleging that OpenAI and Microsoft wrongfully gained from abandoning the nonprofit mission that Musk helped fund in the company's early days. The judge found what the court filing described as ample evidence, supporting Musk's claims, and allowed it to proceed to jury trial. Legal analysts suggest the actual recovery, if Musk wins, would be significantly lower than the headline figure. But the trial itself, the discovery process, the public testimony, the documents that will be entered into evidence, could surface financial information about OpenAI that the company has so far managed to keep private. A company burning $12 billion a quarter, trying to raise money from the same investor community that will be reading those trial documents, does not need additional financial uncertainty. And yet, here it is. So where does this actually end? Because there are really only a few possible outcomes. The first outcome is that the plan works. Revenue grows at the rate the projections require. Enterprise adoption accelerates. The AI agents that Altman keeps talking about, AI systems that can autonomously complete complex tasks and charge subscription fees at scale, actually ship and actually generate the revenue he's been promising. OpenAI reaches profitability in 2030. The $800 billion valuation looks cheap in retrospect. Everyone who believed looks like a genius. This outcome is possible. It requires the technological progress to continue on the current trajectory, the enterprise market to adopt AI at the rate the bull case course requires, the competitive moat to hold despite Google, Meta, and increasingly capable open source alternatives, and the capital markets to remain patient and supportive for another 4 years of enormous losses. Possible. Not guaranteed. The second outcome is a restructuring. OpenAI cannot maintain its current rate of cash burn without continuous fundraising. Altman has described the company's strategy as requiring near constant fundraising to keep it alive. If the capital markets cool on AI, if the earnings season disappointments we discussed in the last video cause investors to reprice their expectations, the fundraising gets harder. And harder fundraising means either accepting terms that significantly dilute existing investors, selling assets, or entering into partnership structures that cede control of pieces of the business. A restructuring doesn't mean the company disappears. It means the $800 billion valuation gets renegotiated downward. Significantly, the third outcome is the one that Bain and Company has flagged, that the NY analyst has predicted, and that Tom's Hardware has reported. OpenAI runs out of cash. The report suggesting this could happen as early as mid-2027 is based on the current burn rate, the current revenue trajectory, and the assumption that fundraising conditions become more difficult. if 2 or 3 major funding rounds fail to materialize on the terms OpenAI needs, which is an increasingly plausible scenario given the earnings season pressure coming in Q2 and Q3 of this year. The timeline to a cash crisis compresses rapidly. None of these outcomes are certainties, but the probability distribution here is very different from what an $800 billion valuation implies. An $800 billion valuation implies a high probability of the first outcome, the plan working. The financial data, the competitive dynamics, the scaling law concerns, and the geopolitical headwinds collectively suggest the probability distribution is considerably more dispersed than that. There is something deeply ironic at the center of all of this. OpenAI was founded with the explicit mission of ensuring that artificial general intelligence benefits all of humanity. It was structured as a nonprofit precisely to prevent the profit motive from distorting decisions about the most powerful technology ever built. And the current situation, an $800 billion valuation, $143 billion in projected negative cash flow, ads in ChatGPT, a Musk lawsuit over the abandoned nonprofit mission, and a CEO who became defensive when asked about the business model on a podcast, is what happened when the profit motive caught up with the mission anyway. The AGI hasn't arrived. The plan to ask it how to make money didn't work. The actual revenue from subscriptions and APIs and now ads is not close to covering the actual costs. And the gap between the valuation and the financial reality is, by any objective measure, one of the largest in the history of technology investment. Whether that gap closes because the revenue accelerates toward the valuation or because the valuation falls toward the revenue is the most important unanswered question in technology right now. And the answer is coming. The Q2, Q4 earnings season, the Musk trial, the helium shortage, the ongoing Hormuz situation, and the growing impatience of institutional investors who have been waiting 3 years for spend now, profit later to become spend now, profit soon. All of these are converging on the same window of time, the company worth $800 billion, the revenue of $13 billion, the losses of $74 billion coming in 2028. The CEO who said he'd ask the AI how to make money. History will have an opinion about all of this. The question is just which opinion it ends up having. So here's where I want to hear from you. Do you think OpenAI hits $100 billion in revenue by 2028 and the plan works? This is Amazon 2002 and the patient investors win? B, there's a significant restructuring, but the technology is real enough that OpenAI survives in a smaller, more focused form? Or C, the cash runs out, the valuation collapses, and this becomes the defining story of the AI bubble, the company that started it all, unable to survive it? Drop it in the comments, because the Musk trial starts in days, the earnings season is coming, and this story is moving fast.